Good afternoon. Welcome to the Hampton Roads Chamber HR Shroom virtual session. I'm Priscilla Monte, Senior Vice President with the Hampton Roads Chamber. Today's session is on insuring your workplace risk. Thank you to our Gold Series sponsor, Let's Pack and Go Dream Vacations. Our presenters today, Stuart Sim is a principal with Morgan Marrow Company. Stuart Sim started with the company working out of the Virginia Beach office in January 1990 as a commercial lines property casualty producer and became a partner in the firm in 1997. His duties include managerial responsibilities for the agency's insurance carrier relations, director of sales team while maintaining the second largest book of property casualty business and largest book of employee benefits in the agency. And Kristina Vaquera is a principal with Jackson Lewis. Kristina is principal in the Norfolk office of Jackson Lewis PC. Her practice focuses exclusively on labor and employment counseling and litigation. If you have questions for them, please put it into the Q&A and either Kristina or I will call on you and we'll open up your microphone. And so now I hand it over to you, Stuart.
Great, thank you. Good afternoon, everyone. It's a pleasure to be here, and we'll just jump right into this presentation. Here. Okay, so this is just kind of the order in which we'll review things. We'll do a quick business overview of Morgan Marrow Company, the role of a broker, risk transfer products and coverages, and then we'll dive kind of into four areas that are management liability lines of coverage, which is employment practices liability, directors and officers liability, fiduciary liability, and cyber liability, which is the fastest changing product line in the industry right now and a huge challenge. So we'll probably spend a considerable amount of time on number 7, and then at the end open it up for a little Q&A and see if there's some things that crop up that we want to elaborate on. Okay, the business overview. Okay, Morgan Marrow Company is a family-owned company. It has 3 partners. Those are the 3 partners. Obviously, I am on the right. Ned Morgan is in the middle, and my brother Michael Sim is on the left. Our website link is in the lower right-hand corner. If you want to learn more about our agency, we have a long-standing established agency started in 1907. So clearly been doing this a long time. This is just a picture of our 2 locations. Most of our processing is handled. We're born out of Hampton, Virginia. Opened in Virginia Beach probably 35 years ago, and that's a picture of our office building on the right. And again, Hampton, our headquarters is on the left. We have 3 divisions at Morgan Marrow Company: personal insurance, which is relatively obvious. That's your homeowners, your personal auto, valuable, anything that you own personally. Commercial insurance, which is our largest division, which is property. You can read the coverages: property, inland marine, time element. That's business income, management liability, environmental liability, auto. We'll talk more about these lines in a slide later in the presentation. And then we have an employee group benefits division in which we offer group benefits such as group health, disability insurance, dental insurance, life insurance, etc. So those are our 3 divisions. Moving on, the role of a broker. Okay. So the role of a broker, and really this should probably be the role of a broker as we see it, is identifying and meeting with the client to try to understand the client's needs and really learn about the business so that we can then create kind of a risk assessment. Insurance is a risk transfer solution, essentially, whereby you pay a premium and transfer the risk to an insurer. It doesn't always end up being transferring it to an insurer. For example, self-insurance, deductibles are a form of self-insurance. So Creating the risk assessment is, okay, what is the risk in your business? Where is it coming from? And what are potential solutions, from self-insuring completely, which is not buying an insurance policy, or it could be deductibles from small to large, or essentially a complete transfer of risk over to an insurer in paying a premium. One of the ways that we approach this, because in my career, for the amount of money that insurance programs cost, I find the consumer to be not as informed as a consumer would want to be in purchasing something that has the significance and the cost associated with it. So what we try to do is really go the extra mile to educate the client in understanding how insurance carriers look at their business, how they try to price the risk transfer program so that they, in the end of the day, can make a profit too, because let's face it, insurance companies are for-profit entities. So what we end up doing is really studying the loss experience of the client. Loss experience would be claims paid to premiums paid. There can be anomalies in that, and generally the timeline we look is 3 to 5 years. The thinnest timeline would be 3. The carriers kind of like to look out to 5 to establish a longer trend. We will manipulate that sum from a standpoint of just what's the best way to put the best picture. You might have, in years 4 and 5 that are further in the past, you may have a large loss, a single occurrence. So really trying to develop what would be a predictable loss experience is what we're really trying to get after. Now, then once we determine that, and we do that by line of insurance, so there'll be property, general liability, automobile, workers' compensation. We essentially then create a cost of goods sold, and in doing these things, you now start to bring your client into the understanding, because if they're a widget manufacturer, they clearly understand cost of goods sold, they understand expense ratios, and then at the end of, what's left over after that is profit. So what we're trying to do is turn predictable loss experience into cost of goods sold, add an expense ratio to it of generally 30 or 35%. In our industry, they call that a combined ratio, and generally that -1 would be the percentage of profit or percentage of loss in the experience analysis. So if you're operating in a loss scenario, you're likely looking at premiums increasing. And so in most scenarios, when you start bringing increased premiums to your clients, they start tensing up. And if the analysis is correct that as a consumer, they don't really understand all things insurance, then they start to lose confidence in you, and then that's when maybe they go get quotes, and you create kind of a frenzy that can be good for the client and also can be bad for the client. So what we're trying to do is just get some understanding with a fellow business owner and bring a parallel to the table that they can understand how an insurance company views their account. So once we end up educating and all coming to an understanding of what this loss experience is saying to us, we would then enter into preparing detailed specification applications, and out to the marketplace it goes. I'm going to back up for a second. We are an independent agency, so we represent lots of insurance companies. And what you try to essentially have as an agency, or at least our approach, is to have a good cross-section of carriers, not every carrier, because it can become difficult to create scale if you have too many mouths to feed, so to speak. So what we try to do is bring a good cross-section of carriers that have broad appetites that can handle the broad cross-section of what our clients bring, contractors, manufacturers, et cetera. We fill in, prepare these detailed specifications out to the insurance community. They go, comes back. We evaluate the terms and conditions from the various carriers. We may merge one carrier who's providing, let's say, management liability lines with another carrier who's providing superior workers' compensation terms, and then a third carrier that is filling in the void. It can, on a rare situation, be one carrier, but what we're finding in the modern day environment is that there are carriers out there that specialize in particular lines of coverage, so combining them generally leads to a better end product for the customer. We then present this risk transfer strategy to the client. If it's a current client, the coverages renew, and they generally renew for an annual term. And then we operate in different roles for our clients, from claims advocate. We're very heavily involved in claims of significant size, I should say. I mean, if you've got broken windshields and things of that nature, that's, we're less involved in that. But big claims, complicated claims, we're right in the mix with the claims adjuster, carrier, and client, advocating and making sure that that is a smooth process. There's nothing that will destroy a relationship quicker than a claim going sideways. So other things we end up doing is monitoring and tracking profitability. As I indicated up in the third bullet point, loss experience analysis. It's important for our clients to understand how they're trending and what that's looking like in their loss experience analysis, so that we can forecast moving forward what future renewals are going to look like. In workers' compensation, it can be a big deal with experience modification, which are kind of like unemployment surcharges. If you have, if your unemployment rating is increasing, then that's just costing the company more money. There's a similar factor in workers' compensation that can be very cost, prohibitive for clients, and it has a 3-year track. And so we want to keep our clients in the know. We implement loss control strategies. We're kind of unique here. Most carriers have loss control. These are people working for the insurance company that come out and look at the operation and point out deficiencies and make recommendations. Generally, what we like to do in that world is if that need exists, we generally contract with third parties that are not the insurance carrier, so that we can get a fresh, unbiased look at what our loss control strategies are. If we do have issues, then those issues can be addressed and improved. And that way, we don't end up getting a demerit out of the gate with the carrier, because when the loss control carrier sends out loss control specialists, if we have deficiencies, those get recorded, end up in the underwriting file, and those become challenges moving forward from a standpoint of controlling terms and conditions. At the end of the day, what we try to do is reinvest some of our commission income in adding what we call value-added initiatives. This could be similar to what I just mentioned. I had a manufacturer at one point that was growing rapidly, and they made roof trusses, and they were cutting fingers off like they were going out of style, and they were in trouble with their workers' comp carrier, which would have landed them in the assigned risk, which would have added probably 40, 50, 60% to their workers' comp costs. And so what we did is what I just said in the prior example is we went out and hired a third-party loss control specialist. We, as an agency, paid the cost for that loss control specialist, and got our act together, reestablished dialogue with our work comp carrier, and moved. And we're still with that carrier today, but so we were at the brink of being non-renewed and seeing significant increased cost, and we were able to both bring value to our client by coming up with the idea and also reinvesting some of our commission income into covering the cost for that value-added initiative. So in a nutshell, that's kind of what we do. Okay, risk transfer. And all right, so this is like coverage review sheet that we use in-house. And these 2 pages here are largely every insurance coverage that exists. And as you can see, moving left down the left side of the page, we've got them in buckets of property, inland marine, time element, crime, management liability. I've highlighted some of those because those are the things we'll be talking about today. Liability, pollution liability, automobile, workers' comp, and there's an employee benefits tab over there as well. Just a couple things, since we're going to talk about the ones that are highlighted, I just want to bring your attention to a couple of them. When the pandemic hit the U.S., well, really the world, business income was and you may have read some of this, business income is a coverage that is designed to essentially make a business whole if they are unable to operate their business. There's a key trigger to that, which is being challenged, frankly, in various courts, but that the premises has to suffer direct physical loss. So roof gets ripped off by wind, fire. And so what happened when the pandemic hit is it did not do direct physical damage, which is the trigger, and hence no coverage. It's been kind of interesting watching that unfold, and we've got a movement trying to push the policies to pay that. The PPP and some of the other government actions have, in many businesses, kind of tempered the damage done from a financial standpoint. But I see moving forward that it might work for something like this in the future. It might be something that works along the lines of flood insurance. Flood insurance there is private flood insurance, but most flood is handled by the National Flood Insurance Program, which is basically the government. And what they do is they pay the insurance community, various insurance companies, to service those policies. So that is how the bulk is done. Terrorism insurance is another example. After 9/11, the insurance community said this is something that we cannot actuarially underwrite and forecast, and so they came up with a scenario with the government in which the insurance community would incur the first X billion of a claim, and then the backdrop would be the government. So moving forward, I do see that might be a way in which the insurance community gets involved in a situation that is like the pandemic, which has catastrophic effects on businesses, but isn't an insured risk. Currently, and if Evan Greenberg, who's CEO of Chubb, has published some interesting articles on it, and essentially saying it would bankrupt the financial institution of insurance. It's just something that can't be underwritten. So, anyway, so I just wanted to bring that up. One other thing I wanted to, social engineering, which is on the right side. So 1, 2, 3, 4, 5 down in crime. This is something, I just word to the wise, social engineering is being tricked out of money, okay? We've had multiple customers tricked out of hundreds of thousands of dollars, in which a bad actor creates a email. Well, initially what they do is penetrate, breach your network system, and in most situations they sit back and watch. They just kind of are hiding there. You don't know they're there. They pick up on an email communication that essentially says, an example of one was, hey, I'm going to go to China. This was a conversation between the owner and the CFO. I'll be in China. I'm going to be buying some equipment. It's going to be hard to get a hold of. I'm going to need a wire. It's probably going to be about $200,000. And so be on the lookout for that and make sure that doesn't get held up. Well, the bad actor sees this, figures out the time differences, creates an email that looks almost like his, just has one little character difference, sends, hey, I found the equipment I want, it's $192,000, need to wire it here. CFO, busy doing what they're doing, expecting it, but not really looking at that close, boom, wires off the $192,000 gone. So social engineering, and we'll touch on that a little bit later, that is a evolving risk that you need to keep your eye out for. A good risk strategy would be follow up before any wiring's done, has to have a physical conversation between the two parties. Most scenarios that shouldn't be too difficult. So all right, let's see here. Okay, move past this. And again, we get to the Q&A. If you see things here you want to ask questions about, we can come back to this slide. So I'm going to kind of just jump into the meat of this. And these are the 4 lines we're going to kind of focus on, and probably spend a little more time on cyber liability, because that is changing by the day, both in liability to clients, exposure to clients, and what it means to your insurance carrier partners and what they're seeing as a runaway train. Employment practices liability. Okay. When employment practices liability is essentially wrongful termination, discrimination, harassment, workplace claims from employees, as well as third parties. So what we want to try to determine when sitting down with our client is what insurance limit makes sense, what retention makes sense, coordination of prior and pending preceding dates, which is if you move carriers over time, you need to match those dates so that if claims come up from the past, the current carrier will absorb those claims. Otherwise, you have to buy extended reporting or tails to policies that you had with previous insurers, unlike you have to do on many types of policies. It's good to maximize extensions of coverage, wage and hour liability, workplace violence coverage. When it comes to claims, carriers establish relationships with law firms and they become panel providers. If you are an employer, when negotiating this or when talking with your agent and you have a particular attorney that you want involved, the time to get approval for that non-panel provider is at the inception of the policy. Otherwise, you will be given a panel provider, and then at the time of claim, the business owner says, "Hey, I've been doing business with this attorney forever and ever and ever, and they have a specialty in employment practices liability. And I want them involved." That is the wrong time to bring that to the table. So if that scenario exists, that is something you want to be communicating to your broker at renewal or at the time you're discussing these coverages. Kristina, you can jump in at any time here if you want to add. I'm going to.
Sure, Stuart. I mean, EPLI, I think, is definitely something that Many employers need to keep in mind, I mean, litigation can be really expensive. I know you're going to talk a little bit about some of those defense costs that they do cover and how they cover it. But when we're talking about federal court, we're looking at anywhere from $200,000 to $300,000 oftentimes to defend claims. A lot of folks don't realize just how expensive it is to defend federal claims, especially here in the Eastern District of Virginia. We're known as the rocket docket, which means we go to trial in about 6 months, which means it's a very compressed schedule, which means a lot gets done very quickly and those fees rack up really fast. And EPLI insurance has become even more important, I think, in Virginia with the huge quantity of employment laws that we saw passed by the Virginia state legislature in the last 2 years, exposing employers to a wide variety of state law claims that are actually more favorable and will allow employees to go into state court, which is a little bit easier, more friendly venue, but also one that's going to go on a lot longer than federal court, which means that our fees may look a lot different as they grow through a state court claim. So EPLI is definitely something that I think folks need to be alert to. I think one thing I see a lot of, Stuart, and I don't know if you see this or not, is that the company is not always communicating internally about what coverage it has. And so I think it's really important that those folks who have the relationships with the brokers who are looking at buying this insurance talk to those folks that are involved in those employment decisions and human resources to see what kind of things they've got going on, what kind of exposure, and ensuring that they've either got this coverage or if they're not going to get this coverage, they know what they're turning down.
Yeah, and it's a scenario in which employees, if you have employees, then and even if you run a good business, there's so much you do not know of that's going on out there, employee versus employee. And it doesn't always have to be a legit scenario. I mean, I think, what is it, 15 EEOC, if you fire somebody and you have more than 15 employees and that person's bitter, they can go file a complaint at the EEOC, and now you got an issue because EEOC is going to come knocking on your door, and you then have to, you have to write your position paper, for lack of a better word, of what the situation is, and that generally is going to require an attorney, because you would not want to go in to writing that paper and imposing your position without some legal counsel. So now you're starting to spend money. So as you can see what's on the screen here, this is a client of ours, and it's pretty straightforward. You can see their maximum limit of liability is $1 million. Insuring Clause A, which is first party EPL coverage of $1 million. They have Insuring Clause B, which is third party. So when you have employees that are out and about and in customers' homes and in the service business, so it's just not specifically employee versus employee or employee versus employer. It can actually end up being third party. So that's real important as well. So these policies are not expensive in the big scheme of things. I mean, when you look, we call them ancillary lines. They are, depending on the company size, there's a lot of players in this space. So that kind of commoditizes the product and drives down costs, so it's good for the consumer. So this is something it'd be very few companies out there that this policy would not make sense, especially when you look at the cost. The rare occasion customers come to us and say, okay, this happened, do I have coverage? And we have to say no. The first question they always ask, how much would it have been? And it's never too much when I give them the answer. So it's important coverage, and it should be definitely part of your risk management strategy. Moving on, here are the two endorsement riders, workplace violence, which is just some PR and so forth associated with if you have a workplace violence incident. Unfortunately, they do exist, and we've all seen them tragically. So that is an important coverage that has basically zero bearing on cost. The one on the right is the wage and hour. this is defense cost only, but this can get sticky when, and probably it's going to get stickier as we approach minimum wage, new minimum wage changes, and so forth and so on. But it's essentially if if you get called to the carpet for a wage violation, there is not coverage in your program in 99% of these policies, but there is defense cost. In this particular endorsement, down in under 1, you can see it's limited to $100,000. Again, not much cost to this. You can push that probably to $250,000, which I think would make sense. So if you're one of the people negotiating with the broker, I would suggest pushing that limit as high as you can from a defense standpoint. As Kristina just acknowledged, legal costs can skyrocket, and getting your day in court is slow and expensive. So
Yeah, I would say, Stuart, one more note on that is that those wage and hour claims are often not just single plaintiff. They're collective or class actions. And so that really, I mean, even if you may be thinking, well, I'm just getting defense costs covered. That's a big deal when it's a class action, because the cost for litigation is driven exponentially higher when we're talking about wage and hour claims. And typically, you can also see an employer hit numerous times in a row for a wage and hour claim, because typically where there's one violation, there are more. And sometimes other attorneys will then turn around and file copycat suits. Sometimes they may even be filed by the same attorney, 6 months to a year later. And so this type of coverage, in my experience, and Stuart, I don't know about yours, I think a lot of employers are always surprised they don't have this coverage. Despite the fact that this is a claim that we deal with very prevalently as employment attorneys on the defense side. And as Stuart says, we're going to see more of them, because those Virginia state statutes, a lot of what they included, not just those minimum wage changes that increase the Virginia's minimum wage and will continue to increase our minimum wage in set terms, but we have an overtime wage law that went into effect. We have a misclassification statute. We have a state agency that's been empowered with reviewing and investigating those misclassification claims. And so, this is definitely one that I think it's a bit of a sleeper policy sometimes for folks. And I think they need to be a little more alert to whether or not they have this moving forward.
Excellent. Okay, we'll keep moving forward. Okay, this is an insurance company's advertisement, really, and then so it just kind of asks yourself these questions, and they phrase it to skew it towards yes answers, which means you need the coverage. So anyway, I won't spend much time on this. I've already kind of echoed the importance of this coverage. Directors, officers, liability. Okay. So this is kind of small, and I'm going to keep moving. But what you have is some on the left side, why do I need D&O insurance? And then we have some claim detail on the right side, which people can kind of look into later when we have a little more time, when they have more time. Essentially, what it's saying is directors and officers insurance is obvious for publicly held companies or companies that have outside investors or stock. But what this is kind of lending itself to is, if I'm a privately owned company, do I need D&O insurance? And the answer isn't essentially super clear. I'll be honest, I don't sell a ton of private D&O insurance. Because historically, if you're a single-owned company, you just don't really understand where claims can come from. But this will do a good job of kind of explaining that. Directors and officers liability insurance, what's nice about it is the coverage is extremely broad. The insurance agreement is extremely broad. So it's basically like, we're going to cover the D's and the O's for everything except, and then you would look at the exclusions. But, example might be you throw a company party. or rent a boat, take a bunch of people fishing, and the boat goes down, and the loved ones sue the company for not protecting the employees. So again, D&O can be very broad. I had a Department of Labor claim against a client of mine, and the D&O insurance, and this was a privately held company, they have a board of directors, and primarily because they have outside directors, they bought the D&O insurance so that the outside directors could feel comfortable that if something happened, they could, they would have some cover, because if you're a director or an officer on a board, then, you are exposing yourself personally to liability. So it is extremely broad, and in the sake of time, because I want to spend some time on cyber, I'm going to kind of move past this slide, and maybe if people have individual questions, we can chat in more detail about that. This is kind of what the D&O form declarations page, $1 million of coverage, retentions, and then prior and pending at the bottom. Same similar assessment form from a carrier, which, if you have yes to many of these, you would be a candidate for D&O insurance. Fiduciary liability. Many fiduciaries fail to understand that they can be personally liable for a breach of fiduciary duty. Traditional directors and officers insurance does not cover fiduciary liability. What is an ERISA fiduciary? Someone who exercises any discretionary authority or control regarding the management of an employee benefit plan or disposition of its assets. Okay, so as we look at this, there are two categories of benefit plans: welfare benefit plans, that's medical plans, group insurance, disability, vacation benefit plans. Pension benefit plans, which break down into two categories, which is a defined benefit plan, which is be more like a pension. The benefit is defined versus the contribution being defined, which is a 401k. 401ks are probably more prevalent these days because pension plans are extremely difficult to financially manage long term. But the exposure in fiduciary liability, with a 401k is not what it used to be, because the market space has basically gone to these managed platforms, whether it's Mass Mutual, which is now Empower, or various others. The business owner, the fiduciary, generally is not controlling it. A lot of 401k are self-managed, so that exposure has mitigated some over time. However, fiduciary liability is extremely cheap, and we do have a lot of people who are not the trustees of benefit plans, like HR positions that handle the medical plans and the disability, and that falls squarely under ERISA, which is a fiduciary liability. And I have an example of a situation that almost caught us in a bad position. And what this is Medicare in group insurance, if you're an employer with under 20 full-time equivalents, then Medicare is primary. And as we all know, people are working well past 65. So if you're a small employer under 20 employees and you're 65 or 66 years old, Medicare eligible, but you're still keeping your group insurance, you're in trouble, because the group insurance for which you're paying a lot of money for is excess. So, and when Medicare comes into play, you have to buy, you get Medicare, you get coverage A automatically, which is hospital. Coverage B, you have to sign up. Part B, you have to sign up for. And then you fill the holes with a Medicare supplement and an RX supplement. So if you are on a group plan, you'd automatically get A, which is hospital, but you wouldn't be in any hurry to go get B and the supplements because you're being insured by the company. Well, not so fast. If you have a claim and the carrier finds out, then you are going to find your primary coverage, or I shouldn't say your primary coverage, your group coverage through your employer is going to become excess insurance, and you're going to be without doctor coverage and without a supplement in RX. What almost tricked us was there's a caveat in here that if you have an employee or a dependent that is Medicare eligible through a disability, then you have to be an employer of 100 or more. So what happened in our scenario was the husband of an employee, they were about a 60-person group or a 60-person employer. Husband of an employee qualified in 2016 for disability. 2-year wait to be Medicare eligible, that's 2018. They never signed up for any of the Medicare, never told anybody. So they stayed on the company's group insurance because the employer pays an incredibly large percentage amount of the cost for not only the employee but the dependent. And then he ends up in the hospital with horrific injuries and monster bills. And the carrier, what happened was the hospital sent bills both to Medicare and to the carrier, and then the carrier was like, why are they sending it to Medicare? And so then it became apparent that this particular person was Medicare eligible. They are a 60-person employee. The carrier stopped paying the bills and said, sorry, you're excess. Now, not to bore you, we worked the situation out, but we were lucky. So this needs to be part of your employee benefit rollout. Because if you get to be kind of 60, 70, 80 person employer, it's not easy to know what's going on with every employee. So and fiduciary liability, which we had in this case, was going to be the bailout for the employer, because had that not worked out in the right way, that employee would have certainly sued the employer and probably sued us, and it just would have been a god-awful mess. But fiduciary liability, extremely inexpensive and offers broad coverage and gives you some real significant cover over managing your employee benefits program, group health insurance, et cetera. This is what the coverage form or the deck page looks like. I'm going to keep kind of rolling. This is, do I need fiduciary liability? Again, this is going to be geared to a lot of yeses, and because it's a product slick and set to try to close some fiduciary liability deals. Cyber liability. All right, this is breaches are happening every day. The technology curve is difficult to keep up with. 3 recent breaches. Okay, solar winds. And before we jump into this, I have a couple quick videos, and I think we're going to shrink down the time, but I would encourage people to go back and listen to some of these videos. The first thing that set the cyber world on its heels was the solar winds breach. And if you want to jump to this, it might have a small advertisement first, but we're going to listen to a couple minutes of it.
Us doing investigations is kind of like the Beatles entering a battle of the bands. They're going to do really well in Battle of the Bands. We're going to do well investigating.
That's Kevin Mandia, FireEye CEO.
You're former Air Force intelligence, is that right?
And I was in what's called the
I think
Air Force.
we're like 2 minutes into it. Can we back it up to the start?
I spent from 1996 to 1998.
A long simmering cyber conflict between the United States and Russia broke out into the open.
Authorities say the Russians targeted some of America's most sensitive and important computer systems.
Hackers breached SolarWinds to infect at least 7 U.S. government agencies.
Government agencies were caught off guard by an unprecedented attack.
That's right. Hackers targeted SolarWinds, a Texas software company you'd probably never heard of. But they make a piece of software that is indispensable to thousands of IT departments, including many of the nation's biggest companies and U.S. government institutions.
Russian hackers were able to sneak malicious code into this widely used software, which gave them a vast list of potential targets. NPR investigative correspondent Dina Temple-Raston got an exclusive look inside the sophisticated attack. Here's how it unfolded.
The routine software update may be one of the most familiar and least understood parts of our digital lives. But this last spring, it became the vehicle to launch an epic cyber attack. Hackers used a software update to slip into some of this country's most sensitive computer networks, which allowed them to take aim not just at the economy, but at our national security too.
I mean, it's one of the most impressive and effective cyber espionage campaigns of all time.
Alex Stamos is the director of the Internet Observatory at Stanford University and the former head of security at Facebook.
They were able to get access to some very sensitive companies and government organizations without getting caught for quite a while.
And when he says quite a while, he means almost a year. And for all that time, the hackers roamed around the networks of companies like Microsoft, Intel, and Cisco, and government agencies like the Treasury, the Department of Energy, and the Pentagon. And the hackers might have kept skulking around those networks were it not for the vigilance of one company, FireEye, which happened to be one of SolarWinds' customers.
That's right. I mean, we only know about any of this because they...
So this particular breach has set the cyber world on edge because the breach was there for so long and they were such large companies. The number of endpoints exposed is still unknown. And as an insurer, when we get to the coverage form, that is what the policy does. The responsibility of if you are breached and the bad actors is what they call the bad guys are, have exposure to sensitive data, personal information data, you as an employer have significant responsibilities to rectify that situation. And a cyber liability policy will fund that, as well as basically take you by your hand and walk you through it. And I'll get a little more into what the cyber liability policy will do for you. But what we've seen as a result of this breach is that carriers are starting to wonder if they've got their hands around this thing, and that what is the, in insurance, basically it's a law of large numbers, spread of risk, and the premiums on these policies are really small. Small businesses could be $2,000-$3,000 a year for $1 million of coverage. And, what we're finding with these types of breaches is that it's not if you get hacked, it's when you get hacked. Let's go ahead and jump to the other one that I think a lot of us will have some familiarity with, which is the Colonial Pipeline breach. And we'll just listen to a few.
Colonial Pipeline CEO Joseph Blunt said Tuesday that his company paid hackers a $4.4 million ransom a day after discovering malware on its systems in early May. The company also hired outside consultants to handle negotiations with the hackers, who were paid in the Bitcoin cryptocurrency. Blunt, who was testifying before the Senate Committee on Homeland Security and Governmental Affairs, said the decision to pay the ransom on May 8 was made by the company itself. Federal authorities, however, were notified of the hack within hours of its discovery. I made the decision to pay, and I made the decision to keep the information about the payment as confidential as possible.
Okay, let's go ahead and stop that.
The information
I would encourage everyone to go back and listen to these two. It's pretty scary. I think we all saw some of the effects of this breach where people were filling up anything that they could tote with gasoline. And the key to this really was the ransom, which I'm going to get to. So again, they paid $4.4 million ransom to get unlocked. All right, let's go ahead and jump to the last one. This happened on Friday before 4th of July weekend, the Kaseya hack. What this did was they went after managed service providers. So we at Morgan Marrow Company use an outside firm to manage a lot of our IT needs. And and Kaseya is a product that they use. So at 2 o'clock on July 2nd, that Friday before the July 4th weekend, the bad actors released this hack. And fortunately, it was caught relatively quickly. But what this is, so the danger in this was, had that been effective, all our IT and firewalls are designed to keep people we don't want to get in out. Well, this person it's like a family member. The firewalls aren't built to keep them out. So if it was successful and you got into these managed service providers, then they would have just gotten a free walk right into everybody, all their customers, vis-a-vis the gateway that is basically the protected gateway or the open gateway to our outsourced providers. So what you're seeing is essentially three different attacks. Large companies with solar winds, an individual breach of a utility or a gas pipeline, and then the Kaseya breach, which is, hey, let's get into the vendors that basically that businesses rely on for their IT support. All right, we'll just keep on moving. See, okay, there we go. Okay, so these are the buckets. Okay, so I'm going to just kind of flip through this kind of quick. This is the declarations page, and you can see from left to right these various coverages at the bottom of the first slide on the left side of the page. That's first party agreement. Okay, that's going to be the insured, that's the business owner, and the damage is done to them. And then there's third party, which is what you owe to third parties in which information got out about them that through your breach. And I'm just going to kind of flip through this quickly. This is the do we need. That is a no-brainer. There's not one business out there that exists other than, if you don't have a computer, that's about the only company that exists that should not have cyber liability. Here is the coverage form. It's super easy to read. Anything that's bold-faced is a defined term. So and this thing goes on for 10 or 12 pages. So I don't want to get too deep in that, but since we're kind of running out of time with the hour, when you see cyber incident response team at the bottom of the first slide on the left side of the page, what essentially happens, you get breached, immediately report that claim. A cyber incident response team is dispatched. Okay, that's going to consist of IT professionals. That will consist of an attorney that is going to digest what the incident response team says was seen inside the system. What information did the bad actors have access to? And if it jumps into third party, then they'll be able to tell you from a regulatory standpoint what the law requires you to do, and then the cyber team will formulate a third component to the team, which would be a vendor that would help you, do all the protocols that are in place to meet those regulatory requirements. But so that's the cyber incident response team. At the top of the middle slide, non-panel provider. Okay, Cyber allows, with this particular carrier, this is Chubb, as you can see, they built in $250,000. So where it was EPL, you need to bring that non-panel provider up at the inception of the policy, or actually before you buy the policy. Here gives you a small bucket to access non-panel providers that might assist in the adjudication of the claim. Business interruption, okay? They shut your business down. You lose revenue. So that's pretty straightforward. Contingent business interruption. They shut down somebody that you are uniquely tied to, so that if they go down, you go down. Digital data recovery, okay? This is, they went in, they damaged files, so we have to recreate files, and that's coverage C in the middle slide. And then D right under it, network extortion. That's the bucket that that the Colonial Pipeline CEO used to pay the $4.4 million. If they, you know, if they had that much, it didn't indicate whether the insurer was involved. But that is the ransomware, and that is starting to get. You're going to see some changes in that in this space, because these numbers are getting out of control, and the carriers are not charging enough premium in all likelihood to handle what is happening. Down at the bottom of that middle slide, third-party liability, okay? So cyber, privacy, network security liability, that's going to be the bucket that pays if information on your clients get out, or information on personal information get out. Payment card, that would be associated with credit cards. Regulatory proceedings, let's see, electronic social media, that's going to be website related. And then over on the right side of the slides, not much there that we really need to discuss. We're going to see a lot of changes in cyber. I had an account recently where travelers would not quote it loss-free because they were a preferred Microsoft vendor. There's a big concern that Microsoft is the next target, because they have they're so embedded in so many businesses and so many lives that they think that that's going to be an area that is a target. So there's a lot of discussion about what type of limitations to put on these policies. But in short, the landscape on this coverage line is changing daily. The ability to defend against it is becoming more and more difficult, because these bad actors are not necessarily sitting in a chair, trying to hack you. They basically create programs that run for, let's say, 48 hours, penetrate who they can penetrate, boom, shut that one down, and then they launch another program. And so we're under constant attack, and as we've all read, we've got governments involved in it. So if you take one thing away from this meeting is focus on your cyber liability program, and I would be looking at increasing your limits of liability. As you can see, this client's got $1 million, and when they come up for renewal, we'll be looking at significantly increasing that, because again, the cost has not risen yet to an area where it would be unaffordable. So this is look for a lot of change in this, and if you're involved in the risk transfer solutions for your company, this is something you really want to discuss with your broker. That's basically it. This is the do we need program, which we already kind of saw, and again, this is the form. And I know we're kind of butting up against our hour, so I'm going to go ahead and stop here.
Thank you, Stuart. Doesn't look like anyone has any questions, but if anybody has a quick question, we have about a minute, and we can open up your microphone quickly, or I can ask you a question for you. But in the meantime, if somebody has one, let me know. I am going to obviously thank Stuart and Kristina so much for your presentation today. We will have this on our website. It will be along with our write-up, so that you can go back and you can have the slides, and you can also rewatch part of the Zoom if you missed part of it. Great news, our next sessions are going to be live. Yay! So again, thank you to our Gold Series sponsor, Let's Pack and Go Dream Vacations. September 22nd, we have virtual investigations presented by Kristina again, and with Melina Redovitz from Jackson Lewis PC. And then November 17th, updating your handbook to comply with the recent onslaught of state and federal changes. And again, presented by Kristina and Melina. Those will both be 11:30 to 12 for lunch, and then 12 to 1:30 for the program. It's $30, and we will be at Prosper Insurance. Thank you to Prosper Insurance for being our venue sponsor. They're at 2929 Sabre Street, number 200 in Virginia Beach. So again, our next two sessions will be live, and we're very excited about that. Thank you again to Stuart Sim and Kristina Vaquera for presenting today. And again, if you have any questions, you can send us an email. We will get them to them. And everything will be up on our website later today. Have a great day.
Excellent. Thank you.